Hello fellow intelligent investors. In my last video, I discussed what Google, Netflix and Facebook's stock have in common and highlighted that if you wanted to enjoy the marvelous returns these stocks generated over the last decade, you needed conviction in order to hold these securities during volatile periods or flat return periods. If you haven't watched that video, I highly recommend watching this video first, because in that video we defined the term conviction. Today you will learn how you can actually build conviction by following a 3-step framework that I will present in this video. So without further ado, let's get started. Alright, maybe for starters. I often say that while you can borrow ideas from other investors by looking at the 13F filings of famous investors, for example, or by following certain people on Twitter. Well, while you can borrow ideas, you cannot borrow conviction. And in my first video, I referenced a blog post of SleepwellCapital. And in that post, he wrote the following: "Conviction can't be taught. It is learned from experience, and you never fully comprehend it." And I agree with him here. Conviction in an individual investment can't be taught. Now, the fact that it can't be taught may sound discouraging at first, but there is actually a step-by-step framework that you can follow to develop conviction yourself without the help of others. And I think there are 3 main steps that you need to follow to develop conviction. And maybe before I share my step-by-step conviction building framework, please let me know in the comments down below how you build conviction. What is maybe the number 1 thing you need to do to gain confidence in an investment? I would love to hear your take on this subject. So, I think the first step is obviously to do your due diligence until you understand the business. Go and research the company you are looking at. I think the 3 magic words that you have to internalize here are research, research, research. And you absolutely have to do the research yourself. I think you should focus on primary sources first. So read a firm's annual reports, the so-called 10Ks. The quarterly reports, the so-called 10Qs. Listen to the company's conference calls. And once you have done that, you can pay attention to secondary sources and read independently written analyses by other investors. Listen to podcast episodes discussing the business, or maybe search the ticker symbol on Twitter. I think nowadays there are plenty of resources that can help you to understand the business and hence help you to develop conviction. Now, this first step probably requires the most amount of work, and it can be quite time consuming. I think depending on A, how easy or complex the business model is, and B, whether you have analyzed very similar businesses in the past, this step can take a few days, but sometimes it might take weeks or even longer to truly understand the company you are looking at and its intricacies. But once you have successfully dig deep into the firm's fundamentals, I think you should be able to answer the list of questions that I shared in my first video on this subject, and I will just show you that set of questions again right here. Okay, so that was the first step. The second step is to invert your ideas. John Boyd, he once said, if you want to understand something, take it to the extremes or examine its opposites. And Monish Pabright is quoted saying, "I don't look for reasons to buy a given business. I look for reasons to reject buying the stock. I'm looking for why I should turn it down. If I can find what I call the slightest pretext to turn it down, I'm done." So what you want to do here is to familiarize yourself with the risks associated with the business. And trust me, there is no company that doesn't face any risks. There are actually all sorts of risks. Systemic risks as well as so-called idiosyncratic risks, so unsystemic risks. Risks unique to an individual company. And those risks could be risks associated with the industry, human risks related to a firm's management, such as execution risk, regulatory risks, competitive risks, risks of changing consumer behavior, and again the list goes on and on. And in fact, there are also lots of unknown risks that you simply cannot predict with the information available to you. As Stephen Johnson notes in his book Farsighted, How We Make the Decisions That Matter the Most, there are knowable unknowns, so those are uncertainties we should be able to identify with available information or experience. For example, how the Chinese government will handle the VIE structures in the coming years is an identifiable unknown risk. And then there are unknowable unknowns, uncertainties that result from the inherent unpredictability of the system being analyzed. Now, obviously, you cannot be aware of all of the risks, and in fact, I believe that is not even what you should be aiming for. You will probably be so paralyzed and worried that you will never make any investment, which could be a very costly mistake. Just sitting on a massive cash pile and letting inflation erode away the purchasing power of that money is suboptimal. So instead, I think you should be aware of the main risks associated with an individual business or maybe the industry it is operating in. And then maybe assign a probability to those risks, and then consider the consequences if those risks actually were to occur. So how do you identify these risks? Well, you will likely come across these risks throughout your research process in step number 1. In fact, companies are legally required to list their main risks in their 10Ks. Moreover, discussing investment ideas with people that have a bearish view on a stock and carefully thinking about their opposing arguments will also help you tremendously when it comes to developing conviction in your bullish view. And lastly, when researching investment ideas and discussing them with others, I think you need to acknowledge your human biases, because you will naturally want to seek out confirming evidence. That's just human nature. But that is not going to make you a better investor. Just because you focus on just one side of the coin, that doesn't mean that you are right in your analysis. So instead, you want to be paranoid about being wrong and deliberately seek out disconfirming information. Try to ignore your confirmation biases and always be aware of the fact that you might be wrong or that the story might have changed. I think there is a very fine line between legitimate conviction and blind faith. While investors need to build strong conviction to be able to hold or add to a position if the stock is performing poorly, I think you absolutely need to avoid blind conviction. So being ignorant. Don't blind yourself to reality and always remain open to your investment thesis being invalidated. So let's wrap up this second step. Personally, to develop strong conviction, the number of risks needs to be reasonable. I think I can only have high conviction in an investment and size the position appropriately if I think there is a very limited downside risk. Now, speaking of downside risk, the last step required to form conviction is to value the asset you consider investing in. You could find a fundamentally world-class business that is earning high returns on capital, a firm with almost no business risks, a long runway for growth, and maybe a perfectly capable management team. But all of these wonderful attributes would be worthless if the price you have to pay to acquire that asset is astronomically high, because then it will turn out to be a poor investment. Now, if on the other hand you can find the very same business that is consistently growing at double-digit rates at a single-digit PE multiple, you have likely found a bargain with very little downside risk. So if the price you have to pay is significantly below my personal intrinsic value estimate, this will absolutely strengthen my conviction in this stock idea, and I'm likely to make an investment. In fact, I would go so far as to say that I can only develop high conviction in a stock if the business is available at the right price. Now, a valid question would be whether one can measure conviction. Well, I would say not really. At least you cannot measure it quantitatively. I would say that having conviction is a mixture of having a lot of knowledge about an individual business and the industry it is operating in and maybe the management team, but then it's also some kind of gut feeling, a feeling of confidence in your chest that you can assess the situation better than most other market participants. However, I do think that you can actually test your conviction qualitatively. On the one hand, I think being able to note down your investment thesis in a short and very concise way can give you an indication of how well you've understood the firm and whether you are able to break it down to the key pillars of your investment thesis, which requires you basically to cut out all of the surrounding noise. And then on the other hand, I think conviction can also be tested by discussing the idea with someone else who is also familiar with the company and maybe the bear case in particular. And I think if you can engage with that person in, say, an hour-long discussion, you are probably on the right track. So how can investors benefit from conviction? Well, I think there are two main takeaways here. First, I started this video series by pointing out a couple of highly successful stocks that have gone through prolonged flat return periods. And I can actually show you another chart here that the Crescent Fund shared. And I will highlight the flat return periods as well as the annualized returns for you. Well, I believe that as a long-term investor, you should love these multi-year flat return periods. It might not feel nice in that exact moment, but these periods actually allow you to accumulate more shares of, say, a superior business over time at a discounted price. And if you have conviction in the superiority of that business, why would you want to pay a higher price? The best performing stocks, they don't usually go up in a straight line. And as an intelligent investor, you want to exploit exactly that. Then secondly, I think if you have no conviction, you are in trouble, because then you are more likely to sell a stock prematurely and you are more focused on the stock itself than the business. You might sell the stock just because it drops 20 or 30% or moves sideways for a couple of months or years even. I think to be able to hold the stock during these periods, you need conviction, and you need to understand that in the short and medium term, a stock's price does not necessarily reflect the business's fundamentals. A business can actually grow for years without the stock price moving at all or at the same pace. In the aforementioned essay, SleepwellCapital quoted Andrew Walker, who is quite active on Twitter and who also runs a blog called Yet Another Value Blog. And Andrew addressed this exact issue, and I think this quote from him is so great that I wanted to include it in this video here as well. He wrote the following on his blog: "If I spent weeks doing work on an idea and I post it on here, someone could read the idea and say, wow, that's interesting, I agree. Buy the stock and generate the same returns as me. For a long time that struck me as unfair, but increasingly it doesn't bother me. Over the long run, I think a person who steals ideas will do substantially worse than a person who develops their own ideas simply because the idea thief won't have conviction in the idea. And that will lead to incredibly suboptimal trading." And with that, I'm going to wrap it up here. As always, may your finances and investments prosper. Good luck.